Hi, everybody. This is RC Peck, the founder of Fearless Wealth and the creator of the Fearless Wealth portfolio. And this is my market situation report for Saturday, January 12th. And I've been thinking a lot about what I want to talk about with you. And I was on a couple radio stations this week and we were talking about one of my strategies. And I just think it's a good idea to go back to and talk about it and why it works well, because this one strategy is really the foundation of why people are able to lower the volatility, lower their effort, and increase the returns over time. So let's talk about what that is. Now, the strategy I'm talking about is LTEC. And it doesn't matter if you use it or not, because I'm going to describe why it works so well. But if you look on the screen here, you see five, it's kind of like a blue-like rectangle, and you have one pink one. The pink one is where we are today. But if you look on group number one, it says average PE, and I'll just get my cursor, average PE 7.7. So in the average PE ratio, as reported PE ratio for the S&P 500 is at 7.7. That means for the next 10 years, one should expect about an 11.4% compounded annual return. Now, if someone has an average, if the market has an average P ratio of 11.2, so that's much higher, notice that the 10-year compounded annual return is 9.2%. Okay? Then we go to an average P ratio of 14.5, and it goes down to 6% for the next 10 years. You go to 17.5, it drops it just a little bit, which I think is interesting that it actually doesn't drop it that much between 14.5 average PE ratio and 17.5 average PE ratio. Today we're right about here, which is there's about an average PE ratio of 18 or 19 on the stock market. And then group 5 is the highest, even though we've gone way above this in the past, 23.4. The next 10 years is about a 2.8% compounded annual return. Now the reason I bring this up is because the bull market that ended in stocks ended with a PE ratio not at 23, but a PE ratio at 40. 40. And this is the cycle. I mean, this is the cycle we're in. We're in the cycle of PE ratios coming down. And if you don't know what a PE ratio, basically just think about how many dollars you're going to pay to get $1 of annual lifetime income. So if the PE ratio on the S&P 500 is 23, that means you're willing to pay $23 for $1 of lifetime annual income, which also means it's going to take you 23 years to break even. So when this whole bull market ended, the PE ratio was 40. So people were paying $40 for $1 of annual income. And today, 12 years into the bear market in stocks, which is really a cycle reversal, because think about it, it's the cycle going from a high PE ratio or a high valuation, people paying a lot of money for that $1 of annual income. Now we're down to, from 40, we're down to about 18 or 19 after 12 years. And typically, these cycles end when that valuation is below 10. So we still have to drop about 9 more PE numbers to get below 10. And that's where we can just start to think about it falling. Now, this is really the same information on this price chart, but I'm using the magic color pink today because sometimes I think people take investing a little bit too serious. So I thought of the least serious color I could think of is pink. So today we have a PE ratio of somewhere about 18 or 19%. And if you can see where these two columns connect, that means the average return should be about 5%. About 5%. Now, it hasn't really been that way. Or actually, let me say it this way. So that means going forward, the next 10 years should be about 5%. Though I don't actually agree with that. I think we probably have about 5 or 6 more years of 5% growth a year. And Warren Buffett even came out and said he expects, and Jeremy Grantham came out and said he expects that the next 4 to 5 years should see about a 5% growth in the stock market every year. Well, if you consider that the stock market's up about 3.5% this year, that means about 70% of the growth for this year happened in the first, 6 or 7 trading days. Now, the last thing I just want to show you was the price chart of the S&P 500 from the year 2000 to, today. but I have 2013 in there. And just what I want to show you with the pink line is that the price has moved down and then up, down and then up. And this down move right here was a 50% drop, a 100% increase, a 58% drop, a 100% increase. And during that time, the valuation has come down. Now, the reason I'm telling you this is because if you get the big picture right, you get everything right. And the LTEC strategy, and LTEC stands for long-term economic cycles, it's really about identifying which direction valuation is going. Are valuations going up on the S&P 500, or are valuations going down on the S&P 500? And when they're going down, that means over the next 15, 20 years, people aren't really going to make any money in the stock market. And in fact, the place that they're going to make money is in gold and silver. And I just find it so interesting that a bear market wants to lure you in, wants to make you feel like, oh, it's safe, it's over. And just look at this. I mean, the market fell 50% at the beginning of 2000. And then people got lured back in, and they're like, oh, or maybe they never got out. And then with this 58% fall, I mean, that is such a severe fall. Now, we absolutely have at least one more recession in front of us, regardless of Ben Bernanke or Obama do. There's just a natural order to things. And my fear is that we actually don't have one. And the reason that's my fear is because if we don't have one, that means we're going to have something much worse coming forward. So the takeaway this week, and just the kind of the situation I see, is how people can consistently want to get the small picture or the short-term picture right. And over time, those people are going to lose money. And I just want you to get the big picture right. And the big picture is you want to own gold and you want to own silver and you want to generally be out of the stock market. Again, according to this one strategy, LTEC, a strategy that I built, that I use, and that I teach. That means continue collecting your gold and silver and continue using some sort of stop loss mechanism for your stock market positions. Thanks, everyone. I'm so glad you were here with me, and I look forward to speaking with you next week. Okay, take care.